Hello and welcome. US bond yields are rising, but the dollar is falling. That's quite unusual. Normally, we have seen that the higher yields support the dollar. So why is this relationship breaking down now? Let's understand what the market is signaling. Over the past few sessions, if you see, US Treasury yields have moved higher, but the dollar index has weakened. This divergence tells us that traditional yield currency dynamics are no longer driving the market. Instead, macro risk, capital flows, and geopolitics are taking the center stage. If we look at the correlation between the dollar index and the US Treasury yields, which is shown in the chart, it has weakened steadily over time. While still positive, but it is well below its historical average. More importantly, in December 2025, the correlation has also turned briefly negative, something that has happened only a few times in the past 1.5 years. This highlights that how unusual the current market behavior is. Moving ahead, let's now see why the US yields are rising. The rising yields is not being driven by optimism around growth or tighter monetary policy. Instead, it reflects selling pressure in the bond market. Heightened geopolitical risk and trade uncertainty have pushed investors to cut exposure to long duration bonds. And as we know that there is an inverse relation between the face value and the yields, as soon as there was a huge selling in US treasuries, the face value went down and the yields went higher. At the same time, reduced foreign demand for US treasuries, partly due to the central banks diversifying reserves into gold, has also added upward pressure into the yields. Now let's look why the dollar is weakening. See, despite higher yields, the dollar is struggling. Why? Because geopolitical tensions have revived the so-called Sell America narrative, leading investors to reduce exposure to US assets. Crucially, rising yields in this environment signal risk and strength, not confidence. When yields rise due to bond liquidation rather than growth or optimism, they tend to weaken, not strengthen the currency, and that's exactly what is happening. From the past 2 to 3 trading sessions, the dollar index is continuously declining, and currently it is around its 2-week low level. Now let's look at the implications. For markets, this means the yield-dollar relationship is temporarily broken. Gold and non-dollar safe havens may continue to benefit, while FX traders need to focus more on capital flows and risk sentiment than just interest rate moves. In short, higher yields don't always mean strong dollar. Until yields rise on the back of growth and policy tightening, not fear and bond selling, the dollar is likely to remain under pressure. Thanks for watching and stay tuned for more such market updates.